Hey everyone, welcome back to Corporate Decoder, the place where we break down the financial statements of public companies. Today we're diving into UPAY Incorporated's latest quarterly report, and let's just say this one has more twists and turns than a pretzel factory. We're looking at a company that seems to be juggling a lot of moving parts, and we're going to decode what that all means for their financial health and future. Stick around as we uncover the story behind these numbers. And hey, before we get too deep into this, if you dig getting straight answers and clear insights from these financial documents, then you got to hit that subscribe button. We also have a Discord community linked in the description below where we keep the conversation going. Let's start by looking at the company's financial snapshot, their balance sheet. As of the 30th of November 2025, UPAY Incorporated reported total assets of about $211,000. Now, that might sound small, but it is less than they had at the end of February 2025, which was around $234,000. So, their total assets have shrunk a bit. On the liability side, things are a bit more complex. At the end of November 2025, their accounts payable and accrued liabilities were about $101,000. That is down from nearly $133,000 in February. But then we see significant amounts due to related parties, which is a big chunk of their liabilities. They owed nearly $270,000 on notes payable to related parties. That's up from $50,000 back in February. This signals a growing reliance on funds from people or companies connected to the business. Overall liabilities were around $698,000 at the end of November 2025, which is still slightly more than their total assets. That means for every dollar of assets, they have more than $1 in liabilities. This is what we call negative stockholders' equity, or a deficit. Speaking of deficits, their accumulated deficit, which is basically the total losses the company has racked up over time, jumped significantly from about $2.1 million at the end of February 2025 to over $3.4 million by November 2025. That is a massive increase in just 9 months. Now let's look at how they performed on the income statement. This shows us how much money they made and lost over a period. For the 3 months ending the 30th of November 2025, revenue was about $184,000. That is up from about $150,000 for the same period in 2024. That is a positive sign showing that core business activities are bringing in more money. However, for the 9 months ending the 30th of November 2025, revenues were about $543,000, which is actually down from $575,000 in the same period of 2024. So the revenue growth in the most recent quarter did not make up for a dip earlier in the year. The bottom line here is the net loss. For the 3 months ending the 30th of November 2025, the company reported a net loss of over $1 million. This is a huge jump from a loss of around $159,000 in the same period of 2024. The main reason for this massive increase in loss, a significant loss on settlement of debt. This loss on settlement of debt alone was a staggering $904,400. This means they paid off some debts in a way that cost them a lot of money, likely by issuing shares worth more than the actual debt value or some similar transaction. For the 9 months ending the 30th of November 2025, the net loss was almost $1.3 million, which is also much higher than the $501,000 net loss in the same period of 2024. The story is consistent here. Large debt settlements are hitting them hard. Now, one small bright spot in the operation statement is the foreign currency translation adjustments. For the 3 months ending the 30th of November 2025, it was a positive $2,367, helping to slightly offset some of the massive losses. This statement really digs into the changes in their equity over time. It shows us how much new stock was issued, how much stock is planned to be issued, and how the profits or losses affect the total equity. We can see here that they are issuing stock for services throughout these periods, adding to their potential future share count. For example, in the 9 months ending the 30th of November 2025, they had common stock issuable for services totaling $102,750. This is a common way for companies that might not have a lot of cash to pay for things like legal services or director fees. And this is where it gets really interesting. Look at the transactions for the 9 months ending the 30th of November 2025. The company issued a massive 800,000 shares of common stock, valued at $1,120,000, to settle notes payable to related parties. This transaction alone caused that huge loss on settlement of debt we saw earlier. Let's move on to the cash flow statement, which shows how cash is moving in and out of the company. This is crucial because a company can look profitable on paper but still run out of cash. For the 9 months ending the 30th of November 2025, the company used about $259,000 in cash for its operations. That is actually an improvement from the $741,000 they used in the same period of 2024. So they're burning less cash on a day-to-day basis. On the financing side, they received $270,000 in cash from financing activities for the 9 months ending the 30th of November, 2025, which is more than the $100,000 they received in 2024. This suggests they are getting more external funding, likely through loans or issuing more stock, to keep the lights on. Now, a really important note here is in the nature of operations and continuance of business section. It states that the company does not have sufficient revenues to execute its business plan. This is a huge red flag. They explicitly say they intend to fund operations through equity financing, and there is no guarantee that will be successful. This raises substantial doubt about the company's ability to continue as a going concern, meaning to raise a real question about whether they will be around in the near future. They are very upfront about this inability to continue as a going concern, basically acknowledging that without new funding they might not survive. Looking at their property and equipment, it is relatively small. For example, as of the 30th of November 2025, their net carrying value of computer equipment was only about $1,372. This indicates they are not a capital-intensive business. Their right-of-use assets, which are related to leases like office space, are more substantial. As of the 30th of November 2025, the net carrying value was about $50,950. This indicates they do have ongoing lease commitments. The notes detail a significant amount of due to related parties. Some of these are loans from the CEO and companies controlled by significant shareholders. For instance, they have several promissory notes with the CEO totaling $70,000 in principal plus accrued interest. They also have notes from companies controlled by significant shareholders, some of which were settled by issuing a large amount of stock. This highlights a deep intermingling of personal and corporate finances, which can sometimes be a sign of a company struggling to secure traditional financing. We saw the massive impact of debt settlements on the income statement, and this note clarifies it further. On the 11th of November 2025, they issued 800,000 shares to settle notes payable to related parties. This is a very common tactic for struggling companies to get out of debt when they don't have the cash. But it significantly dilutes the ownership stake for existing shareholders. The company also faces significant customer concentration risk. For the 9 months ending the 30th of November 2025, almost 34% of their revenue came from just 2 customers. And as of the 30th of November 2025, about 50% of their accounts receivable was from just 3 customers. This means if they lose even 1 or 2 of these customers, it could have a huge impact on their revenue. This section is particularly concerning. Management admits that their disclosure controls and procedures are not effective. They haven't developed and communicated their accounting policies and procedures well, leading to inconsistent practices. Furthermore, the board of directors has no independent members and no one qualifies as an audit committee financial expert. This is a serious red flag that suggests a lack of robust governance and oversight. They essentially confess to not having adequate internal controls, a situation they call a material weakness. Now let's talk about management's perspective. They mentioned that revenues increased in the 3 months ending the 30th of November 2025, primarily due to more transactional revenue in their South African operations. But as we saw, the 9-month revenue actually decreased. They attribute the increased net loss to that significant loss on settlement of debt. This seems to be the overriding factor in their financial results for this period. Expenses have decreased overall, largely due to lower general and administrative costs in their South African operations. This is a positive sign that they are trying to control operational spending. When it comes to liquidity, they have negative working capital, meaning their short-term liabilities are greater than their short-term assets. This is a classic sign of potential cash flow problems. They are burning through cash in operations, and it is clear they are relying on financing activities to stay afloat. So, what is the story here? UPAY Incorporated is clearly in a tough spot. They are generating some revenue, which is good, but they are consistently losing a lot more money than they are making. The massive losses are largely driven by debt settlements, which involve issuing a lot of new stock, diluting existing shareholders. The company is openly admitting they might not be able to continue as a going concern, and their internal controls are weak. The company is heavily reliant on related parties for funding, and it appears they need to secure more equity financing to survive. The customer concentration also presents a significant risk. While they are trying to control expenses, the core issue remains their ability to generate sustainable revenue and profits without relying on debt settlements or further equity raises, which further dilute ownership. In my view, this company is a very high-risk investment. The fundamental numbers show a business struggling to become self-sufficient. And the lack of strong internal controls and governance is a major concern. Unless they can significantly turn around their revenue growth and achieve profitability without a constant stream of external capital or a massive influx of new customers, the future looks uncertain. Alright, that is our breakdown of UPAY Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.